All right, I think we might be operational this morning. If you're out there and you're hanging out with us, hashtag coffee break. And away we go. All right. Well, welcome. Welcome to the Construction CPA's Coffee Cafe. I am Lisa Raish, the CPA. Oh, yeah. Okay. I am Lisa Raish, the Construction CPA. We're dropping the hammer on cash flow problems so you can build things that matter. And today's topic is strategies for reducing your overall tax liability as a business owner. So some of the things that we're going to talk about today are the kind of the go-to things that we as CPAs use when we're thinking about reducing tax liability for business owners. So as a business owner, depending on the type of entity that you are in, is going to depend on how you're taxed, right? So, for instance, a C Corp is an entity of its own, it gets taxed, the owner gets taxed separately. What we tend to see a lot of is we tend to see pass through entities, which typically are going to be LLCs filing as S Corps or straight out S Corps, or we do have some clients that are sole proprietors and so on. So, there's going to be different effects. So when you are operating as a pass through or a sole prop, really the income tax liability ultimately falls on you as the owner. It passes from the entity onto you. So again, we're looking at what can we do on an entity level, and then what can we do to help ultimately the owner in the end save on their taxes. So the first thing that we look at, or first thing that we will evaluate, is your business structure. How are you structured? Are you currently operating as a sole proprietor? Are you operating as an LLC, a single member LLC, which the LLC does not exist for tax purposes? It's strictly a legal vehicle. So you have to kind of pick a type of entity that you want to be taxed as. So maybe you're operating as that single member LLC, operating as the sole prop, or maybe you're the LLC. So if you're in that, or an LLC filing as a partnership, you're two people, we would look at something like that and say, hey, is there a way that we can save on from a tax perspective by moving you to a different type of entity? Because the sole proprietor and the partnership are going to ultimately, the partners will ultimately get taxed on for self-employment. They'll be charged self-employment tax on their personal tax return. So a lot of times we're looking at that number and seeing, hey, can we save some of that self-employment tax by moving it into a different type of entity? Can we, as that single member LLC, can we elect for you to be an S Corp or a C Corp? Or, are you a sole proprietor? Does it make sense to elect actually to be, to incorporate and elect to be an S Corp and so on? So we're looking at how can we save you money there? So your partnership and your sole prop are paying self-employment tax. Your corps, your S Corp and your C Corp, your owners are paying themselves a salary. And then the S Corp, any balance of income coming through the entity, from the entity, is taxed by the owner. And then the C Corp actually pays its own tax. So can we save on self-employment tax by moving you into a corporation type of structure? So those tend to be some of the things that we think about when we're looking at, can we save a sole proprietor or a partnership money by kind of reorganizing the way that they're structured and get them into a different structure with a different kind of a tax structure. Another way, again, to think about it too, is are there business expenses? Identify all the business expenses that you have. What are the common deductible expenses? Your office, your rent, we're all using technology now. So we're all using various softwares and internet and technology related expenses in our businesses. You're going to have, if you have team members, you're going to have a headcount expense. In most businesses, headcount tends to be the largest dollar you're going to spend. So again, make sure you've identified all of the common expenses, but you are also keeping track of your expenses. If you are spending in your business, you're keeping your receipts. We've talked about this before. The receipts don't have to be kept in a paper format. I personally, and for this business, we use a product called Dext, and that's where I bring all of my receipts in from. So if I have a paper receipt, I take a picture of it. If it's an email receipt, I'm sending the email over to the product. It's a place for me to aggregate all of my receipts. I attach my receipts into QuickBooks Online when the expenses come through. It's an orderly way to keep your records. So again, you want to keep proper records. You don't have to keep it that way, but however you choose to keep it, you need to keep orderly records. You need to be able to go back and look to see, this actually was an expense. This was a deductible expense. Oh, this wasn't a deductible expense, and so on and so forth. Another thing to think about is there are a number of tax credits out there. So we're not talking about actual tax credits for you as the individual. These would be tax credits for your business. So one of the big ones is the R&D credit, or the research and development credit. For a long time, R&D was a credit that was there to drive innovation in manufacturing. Over the years, the credit has been expanded, so you'll see more tech companies. Tech companies are using the R&D credit because they are doing research and development on their softwares or improvements to their softwares. That's an area that you'll see the R&D credit. One of the really interesting ways to use the R&D credit now and in recent years is we're seeing it being used in construction. So are you creating and building innovative structures? And in that, you have the ability to use the R&D credit for the innovations that you're using. Are you using new construction techniques? Are you using new products in new and interesting ways? So R&D credit is now, or research and development credit has now been opened up to construction in recent years, and is something that many construction companies could potentially use as a credit, in their business for, again, when they're out there and they are creating new structures, and again, using new innovative techniques, new techniques they actually created themselves, and so on and so forth. There are going to be other business and investment tax credits. There are going to be credits for payroll tax related things. So for instance, the work opportunity tax credit is going to be a credit available to you as an employer when you're hiring on individuals that are coming out of specific types of socioeconomic areas. So for instance, if you are hiring veterans, or you're hiring ex-convicts, people who have just or coming out of the prison system, if you're hiring women that are trying or coming off of the welfare system, there are tax credits for you as the employer to bring these individuals on into your business. So again, there are tax credits available to you. So that particular one would be a payroll tax credit for you. The one that I know everybody has been talking about in the last 3 years, especially with COVID, and one, again, has been all over the papers and all over the internet recently, is ERC. So that had to do with COVID. Those were COVID related credits. And again, with any credit, there are going to be requirements for you to retain or obtain those credits. You want to make sure, especially when you get into the tax credits, when you get into something like R&D, when you get into things like the payroll tax credits, there are a number of entities or companies out there, or CPAs, that specialize in those tax credits because they are very specific credits. They can be very lucrative credits, but they're very specific. So when we identify that opportunity in one of our clients, we typically go out to a partner that we work with, a referral partner, and we use them because they specialize in that. So they'll back it up if it were to ever be audited, but these can be very lucrative tax credits for you. Another tax credit that we see that is tends to be a lucrative credit for our clients is in construction. We tend to see a lot of our clients also in the investment real estate space. So they're buying investment real estate, rental properties, residential rental, commercial rental. So another opportunity with these commercial and residential rental properties is what's called a cost segregation study. And on a really high level, instead of depreciating the property over what the given period is for the entire property, they break it down into smaller pieces, and then you accelerate the depreciation of the property over, accelerated periods. Again, I have a colleague that we refer out that specializes in this. This is all that they do, but these can be very lucrative credits for you as a small business owner. So something to kind of think about as you are, as you're coming to the close of the tax year, like, are there additional credits that I could potentially, benefit my business, and just takes a couple minutes of you sitting with your tax advisor, kind of talking about, hey, are there any additional credits out there that I could potentially be eligible for? Again, we work with construction a lot. You've heard me talk about that over and over again. One of the big things for us is depreciation and amortization, right? So our clients are buying a lot of equipment. They are buying trucks. They are buying tractors and large, heavy equipment. So there are various strategies that we can use when it comes to potentially accelerating depreciation and therefore accelerating the expense and then potentially bringing the taxable income down. There are a number of different things. There are going to be different accelerated rates. The one you tend to hear a lot about is kind of the Section 179. That tends to be where you can depreciate the whole thing in 1 year. There'll be other bonus depreciations. It's just going to depend on the type of asset you've acquired. So again, something to talk about with your tax advisor, especially when you're doing your tax planning. Is there an opportunity to buy some equipment, in a specific year versus another year, because you could potentially utilize that tax benefit in that year. The other things is, again, we talked about ERC, the employee retention credit. The reality is most of the companies out there, like preaching, ERC, are trying to really push the envelope on it. So I would be careful. I've had our own clients who are getting emails and telephone calls, and they're still asking, am I eligible for this credit? And the reality is, I don't believe they are. A lot of these companies are really pushing the envelope, and you may need to, they may need to represent you, in front of an audit when the service really starts to dig into these credits and look to see who is and is not eligible. So just be careful. I get the calls to my own office, so they'll promise you the world, but just make sure you do your due diligence. Speak to your own, tax advisor as to whether or not they think that you're eligible. Unfortunately, a lot of the companies that are out there that are kind of chanting ERC are really pushing it, and it may not fall the way that you want it to. So it may be something that you really want to be careful about. Another thing that we tend to look at, or an option or an opportunity for tax savings, is, and we've talked about this previously, is retirement. What can you do any kind of retirement planning? So can you set up a retirement plan? Can you set up a 401k? It might benefit not only you as the owner, but maybe your employees as well. So now you're improving your benefits packages to your team members. So you're giving more benefits for them to engage in. And if you are matching, say, on a 401k, that's also an additional expense deduction for your business. So again, retirement may not just benefit you, the owner, it may also benefit your team members. And there are other retirement options out there. There's going to be the SEP IRA. There's a simple IRA. There are a number of different options out there. So again, those are all different things that you can investigate. Some are going to allow you to capitalize on contributing more funds than others. You just want to look to see which one makes sense for you. Again, we've discussed it before. 401k tends to be a little bit more costly to maintain, whereas something like a simple IRA, you can't contribute as much as a 401k, but it doesn't have much of the associated expenses and fees that, say, a 401k would. So again, Not that you want to overspend in your business, but realize that any expenses you pay for 401k compliance or matches on 401ks, those are all deductible to your business and will ultimately help you reduce your overall tax liability. And again, the employer contribution, all potentially tax benefits. And then there is an actual special tax credit for the first year that you do engage in a 401k and you set up that 401k. There's typically costs associated with that. So there is a special tax credit related to you setting up that 401k as well. So again, there's a number of different things that you can kind of look at. You can kind of pull from here and there, a couple of different, different places, so that it's not just, oh, there's only one tax strategy. No, there's a number of different tax opportunities and opportunities for savings that you can find kind of throughout your business. Another thing to look at or think about is things like capital gains and losses. You may be selling a piece of equipment, or you may be ready to trade in a piece of equipment. So what does that trade or that sale of that piece of equipment, and again, I'm using that as an example because that tends to be a lot of what we work with clients when we're talking about capital gains, is, can we manage whatever? Can we maybe sell in a different year instead of this year? Maybe next year we could, because if there is going to be a gain on the sale, how is it going to affect this year? Maybe we want to push it into next year. Those are the kinds of things when you're doing your overall business planning, you're doing your forecasting along with your overall tax planning, you're looking at those things together. Again, I use equipment, trucks as kind of like a go-to thing that we talk about, but that can have a very sizable impact on your business for a number of reasons. It could be additional depreciation for the year that you purchase this asset. You have to think about from a business perspective, it's cash flow. Are you paying outright for this truck, this piece of equipment? Are you financing it? So there's going to be, again, a repayment, interest expense, again, all expenses towards your business, but things to think about. So when you're doing that planning, that overall business planning, I'm trading in a vehicle this year to get a new one. Do I want that trade in this year? Do I want it next year? Could I use any kind of, could whatever capital gains are coming out of, again, you hope that when you trade in your vehicle that you do get a gain on that. Sadly, sometimes we do see clients with losses, but again, something to look at, right? Is there a capital gain situation that you need to manage? Is there a depreciation situation that you could manage and potentially put into another year instead of this year? Again, all things that you want to think about. It's part of your business planning that you put together with your tax planning, because you want to really think about those things together. We see it too often, sometimes clients love to run out on December 20th and, oh, I bought a truck. I need a depreciation. Well, we actually probably maybe need to depreciate it next year, but you bought the vehicle now. So again, you want to plan those things. That all becomes part of your business planning and your tax planning. Again, things like cash versus accrual. So are you cash basis taxpayer? Are you accrual basis? So we've got a number of our clients that for business purposes, we track accrual, but for tax purposes, they're cash. So we're looking at where is the cash coming and going as we get closer to year end. They're spending a lot of money at year end, but, we've got a ton of receivables sitting out there. And so, how can we manage the fact that those dollars for tax purposes are going to show up next year? And how is that going to affect the next year? And what can we do this year to kind of mitigate things that will happen next year, and so on and so forth? So again, there's a level of planning that comes into that cash versus accrual basis when you're getting closer to year end. How can we manage any potential tax liability coming up at year end? So you want to choose the right method. There are advantages to each. There's no one right way. There may be a better way for you versus, say, a friend of yours. So just because you do things one way doesn't mean, a friend does it the same way. Again, you want to look at that like you look at everything else in your business. What makes more sense for, the cash versus accrual for tax purposes? Again, you want to make sure as always, if you have any kind of state compliance, local compliance, that you are maintaining your compliance with your state and local regulators. Some of the states have local, so some of the clients were filing local tax returns for them. Not every state has it. So again, it's something that you want to think about, something that you want to make sure that you are considering. And you're also thinking, is there any kind of obligation I'm going to have from a tax perspective on a low state or local side? Again, let's talk about growth, right? So if you are planning business growth, what does that look like? Structuring your expenses to not only grow your business, but again, meet any kind of tax liability. So we talk about tax planning at the same time that we talk about business planning. What do you want to do? As you come to the close of the year, what do you plan on doing next year? How can we build in whatever plans that you have in your business to, again, maximize your tax position at the same time and the implications? So you're looking at those different types of things. One of the ways that clients are growing a lot in recent years is there's more mergers going on or more acquisitions. Clients are selling their businesses or they're buying other businesses to move into, especially in construction, we see where clients are looking to move into other areas, regions, cities, and they can do that by purchasing an existing business that's already there. So when you do that, whether you're the buyer or the seller, what are the tax implications of all of this? What does that mean for you from a tax perspective, in that year or any subsequent years? And again, something you want to think about and look at as you are doing your business planning year to year. If that is something that you are planning, you're considering as being an option, right? I'm looking to buy a business. No, I actually want to sell my business in a couple of years. What can you do to, again, maximize the savings so that it benefits you, as optimally as possible? And like anything else, you want to do an annual tax review. You want to look at it prior to the close of the tax year. The only tax planning you can do in January is to plan to pay your tax due. So get ahead of it. Talk to your tax person in advance. Don't wait until December 20th to do it. There can be things you can do. You tend to limit what you can do as you get closer to year end because you just run out of time to implement things. So this should be a conversation that you're having, mid-year and then, towards the end of Q3 to ensure that you've kind of capitalized on the options that are available to you. I know I've thrown a lot at you this week. We always love to hear from you. So if you have any questions whatsoever, please drop them in the chat. And as always, we look forward to seeing you every week. Have yourself a fabulous weekend, and we'll see you next week.